If you are a landlord, making tax digital works a little differently to how it works for a sole trader. Multiple properties, joint ownership, mortgage interest, overseas lets. These all have their own rules under MTD, and getting them wrong is easy. So in this video, I am skipping the basics and going straight to what actually matters for landlords specifically. Here is what is different for you. First, the good news. If you own more than one property, you do not file a separate update for each one. All your UK property income combines into a single property business. 2 properties or 20, it is still just 4 quarterly updates a year, not 4 per property. But here is the important exception. UK property and overseas property are treated as 2 separate income streams. If you let a flat in Manchester and a villa in Spain, those are 2 distinct property businesses under MTD, each with its own records and its own updates. So combine your UK properties, but keep anything overseas completely separate. This is the one that trips up the most landlords. Since April 2020, you cannot deduct your mortgage interest as a normal expense. Instead, you get a tax credit worth 20% of your finance costs. Under MTD, that means 2 things. You must record your mortgage interest separately from your other expenses in every quarterly update, not lumped in with repairs and insurance, on its own. And the actual 20% credit is not applied in your quarterly updates at all. It is calculated at the year end in your final declaration. One practical tip. If you do not know the split between capital and interest on your mortgage payment during the year, you can record the full payment and adjust it at year end. HMRC allows that. Just make sure the correction happens before your final declaration is submitted. If you own a property jointly with a spouse or anyone else, you only report your share, your slice of the income, your slice of the expenses, based on your ownership percentage. If rent goes into a joint account, your digital records need to clearly show how much of it is yours. There is also a useful concession for jointly owned property. HMRC lets you report just your share of the income in your quarterly updates and deal with the related expenses at the year end instead. That can simplify your quarters, but note, this only applies to jointly held property. For anything you own in your sole name, you report both income and expenses as normal every quarter. And one more thing. If your share of a jointly owned property is below the £1,000 property allowance, you may not need to report it at all. So for a landlord, your digital records need to capture rent received, including any extras like parking or service charges, your allowable expenses, letting agent fees, insurance, repairs, professional costs, your mortgage interest, recorded separately as we covered, and all of it kept digitally from the first day of your MTD tax year. Remember, repairs are allowable, but improvements are not. Fixing a broken boiler counts. Upgrading the whole kitchen does not, though that may reduce your capital gains tax when you eventually sell. Keep those 2 categories clearly separate in your records. So here's what to take away. Combine your UK properties into one update stream, but keep overseas properties separate. Record your mortgage interest on its own, and remember the 20% credit lands at year end, not in your quarters. If you own jointly, report only your share, and keep repairs and improvements clearly apart. Get those landlord-specific points right, and the rest of MTD is exactly as it is for everyone else. Subscribe to A1TaxFiler, and our full written guide for landlords is linked below if you want the detail in writing.